mechanical engineer from IIT Delhi, an MBA from IIM Calcutta, 26 years of fund management experience, one of the nicest persons I've interacted with, and a person who does not give interviews easily. It's an absolute honor to have with us Mr. Chandresh Nigam, who has kept many of our customers very happy. So it's a welcome.
Thanks for having me. Wonderful to be here.
Okay, so I was doing some reading up, and most viewers don't know this, but Axis Mutual Fund is a very young fund, and Mr. Nigam actually joined as the founding member team, and in 2013 is when you were elevated to the managing director and CEO. And I think that's when things started getting very interesting for Axis Mutual Fund. As a fact, the AUM of Axis Mutual Fund when Mr. Nigam came in was about 10,000 crores, 12,000 crores, and now it's I'm sure a matter of absolute proud for you and your team that Axis Mutual Fund is now more than 100,000 crores. That's 1 lakh crores of AUMs that the team manages. So let me get right to the point. It's a great place to start. To grow a book from 10,000 crores to 100,000 crores, so what did it take and what were the learnings that you got along the way?
So actually, you're right. I think we've just completing 10 years of our existence. In that sense, compared to many of our esteemed peers, we are a much younger organization. However, I think it's a very different kind of an organization. The approach to business, the approach to what is the heart of the business, which is essentially investment management, has been fairly differentiated in a sense that it really adds value to our customers. So the AMC has always been focused on doing what is right for the customer, align product portfolios in line with long-term needs, aligning it to long-term needs of what a customer wants from that particular product, which is always medium to long term. It's not about the short term things. And we've understood fairly early in our journey itself that do the right thing, control risk across all portfolios, manage them well, have a process, build out an institution, and essentially those have become the building blocks on which then you can actually take a lot more assets on your book and feel confident that you will be able to do a good job with it. So we're very happy that we've been able to do a fairly good job with our, I would say very good job with, for most of our investors, in fact all of our investors. All products, we haven't disappointed investors. I think people who have been with us medium to long term, I think they should be pretty happy with our performance over the period. But as I said, I think there's been a lot of thought in terms of building the process, building out the approach, building the investment strategy, and also then the process to execute it. So yes, it's been a good journey.
So I have been your investor now for about 6-7 years, and the fund which I invested first was the Axis Long-Term Equity Fund, right? And that's the fund which is still today, I think your marquee fund, right? With some.
It's our largest equity fund. Yes.
Correct, 21,000 crores, and it leads the tax saving category as well.
Yes.
So this fund has been giving top performance year after year. What's the secret to this superlative performance?
Okay. So while it is reflected in many of our funds, in fact almost all our funds, certainly in the long-term equity fund, the basic strategy of investing in equities in Axis has been fairly differentiated, but it is similar to all our funds. Our approach has been to go at the heart of the value creation process in equities. We all know, we tell investors that equities is where you make money. If you want to create wealth, you have to invest in equities. But we've gone a step further. What we are saying is it's not as if that you can just put money in any equity and it will give you returns. In fact, data is very counterintuitive. That actually most businesses in equities or companies actually destroy wealth rather than create wealth. In fact, globally, about only 4% of businesses create wealth, which means they earn more than their cost of equity. And the reason is that equities is, business as such is risky area. So people who have not been able to manage, who have not been able to sustain, actually fall by the wayside. Interesting thing is we have nearly, I think, 9,000 companies listed on the Bombay Stock Exchange, but I think only about 2,000 get traded, so 7,000 are out. So what we have found out is, when I come back to this, what is the heart of this whole wealth creation process, it is limited to a few companies which sustain high quality growth over a long period of time. They are the wealth creator.
Is this the 4%?
Part of the
referring to?
4%, yes,
Okay.
absolutely. So these are the companies, these are the businesses which have pricing power, and that is why quality of the growth is there, and then they grow fast. So that is actually the key to long-term wealth creation. And that's a strategy we have deployed across all our funds. So we have a very exclusionary process. So as I said, there are 2,000 companies listed. We are only interested in about 250 to 300 businesses where we think they have the potential over the next 5 years to grow much faster than the rest of the corporate sector. But more importantly, we have the good growth, which means it is accompanied by growth in cash flows, high ROEs, return on equities, etc. And we have seen these are the things which the markets really like and rewards these companies which higher valuations over a period of time. So in that sense, this also becomes our prime risk management strategy. As I said, that there are many businesses which fall by the wayside. If you're able to get a portfolio largely of these kinds of companies, irrespective of valuations or what we call P in the market or the nature of the market, whether the market is in bear phase or bull phase, if your companies have grown profits fairly well over the last 3, 4, 5 years, more often than not, you would see the stock price also do fairly well. So this is what is reflected in all our portfolios. The one difference in long-term equity is that it's a 3-year lock-in product. It's an ELSS product. We've had a large number of investors. It allows the fund manager to actually invest with a 4 to 5 year view, because it's not in a business of trying to know the next 6 months or 12 months trying to make returns, and this product is really suited for that. Right. So if somebody comes in, he's anyway there for at least 3 years. What we have seen is that there are people who are there for far longer. And it allows the fund manager to do the right thing. So that's an additional advantage in running this product. Another interesting thing I should tell you is that actually there are, in this 29,000 crores of AUM which you mentioned, I think there are a large number of investors who actually have not come in for the tax benefit. They've just come in because it's been a great wealth creating vehicle.
But this gets me curious. So you mentioned pricing power, you mentioned high ROE, you mentioned really good growth. All of them seems to be hallmarks of large cap companies which are industry leaders, etc. But Axis has been doing tremendously well in the small cap category as well, right? Some of these numbers are really unbelievable. Your 1 year returns are up 23%, while the actual small cap index is actually down.
So I think rather than go into the numbers, I think one thing I'd just like to correct. We are looking at great businesses. They are available across the market cap spectrum.
Okay.
Approach to investing is to buy high quality businesses which will sustain growth, quality growth over long run. They could be a small cap, they could be mid cap, they could be large cap. It's the same approach which we deploy. So to say that these will be only large cap companies is not right. In fact, we've seen many of our very small cap companies, we may have bought them at less than 500 crore market caps, and now they have actually become large caps. So so our job is to find these good companies, and over a period of time, as we engage with the companies and we do research on these companies, to build that conviction that yes, over the next 4 or 5 years, which is typically our investment horizon, we feel confident that they will be able to deliver really strong growth and earnings.
Also, another observation that we've had is that Axis tends to follow a very growth style of investing. Growth, aggressive growth, this thing. But generally, you're not kind of labeled as a value stock or a blended value stock. Any reason for?
As I said, I think if you just do some data work around where the wealth has been created long term. Long-term wealth has to be created in businesses which have grown. See, in the short run, you can create wealth by buying a stock. Even if the business is not doing well, there could be various reasons why the stock can go up
Right.
and you can
Some
make
news or
some money,
something comes
some
in.
money, or the stock is just too much beaten down and
Right,
you can,
right.
some normalization may happen and can make some money. But that is not our style. Our style is aligned to where the sustained wealth has been created by companies, by businesses essentially. So when you look at that, what is the basic nature of these businesses which I have created? But as I said, these have to be high growth
Correct.
businesses. High growth businesses with growth in cash flow. There is this very interesting example of China, for example, where you've seen corporate sector probably growing at 15% last 25 years, but the stock price growth is only 5%. Why? Because while the sales growth is there, the profit growth and cash flow growth has not kept pace. And that's why pricing power and cash flow becomes very important. So you have both of these. You have high growth in cash flow. Actually, that's what you need. If you get good pricing power in a growing industry, I think you've got it all. Ultimately, you will get the growth in cash flow. You will get the IROE, and you will get the increase in price as well, stock price as well. So we are very focused on just this activity. We're not saying that other ways you cannot make money. But we believe this is one of the least risky ways and more predictable ways for a medium-term investor to actually create wealth in the market.
Also, when we see how Axis funds have performed over the years, there was only 1 year where it could not get into the best performing schemes for that year. I think that was 2016. What might have gone wrong there, or maybe some of your bets did not fructify? And have you changed anything over the next few years to kind of rectify that?
Very good question. So nothing, we didn't change anything.
Okay.
We continue to focus on great quality businesses and just did what we had been doing 7 years. We started in 2009-10, so whatever we had been doing, and even today we continue to do the same. What did not go well is more from a relative perspective. So it's not as if that this high quality strategy will work every year. So let's say you have 10 years. We know over 10 years it does very, very well. But individual, you may have a year where it does not do that well. 2016 was a year where globally high quality did not do well. If you were to just segment the market and say, let's look at high ROE versus low ROE, you'll actually find the poorest companies in terms of long-term ROE, return on equity, which is what companies should be. Is one of the important metrics which they should be evaluated by. Actually, that segment did the best. In other words, I don't know if many people know that, but let's say high beta is generally seen as a risk evaluation of what is the risk of a particular stock. The highest beta stocks did the best in that one. So it was a year where the markets, and this is a global situation, not just local. So we were at the receiving end of this trend. But to say at that point in time or in that year there are companies did badly, underlying whether their profits fell or their growth, no, nothing. I think these companies continue to do well. What happened largely was a phenomenon of the market.
Right.
And that is why I think when people actually started to see after us in 2017, and then we started to see how the portfolio and the underlying businesses were doing, and then the portfolios did reasonably well, they were actually quite struck by the fact that we really stuck to our guns. Despite the fact that that strategy was not working, the kind of conviction we showed in the long-term potential of the strategy made us just stick to what we were doing.
Right.
And I think that's something which has been fairly well admired by the investing ecosystem, advisors and investors alike.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.